I'll, I'll do the agenda first. Do we need to make any modifications to the agenda as it's written for May 13th, 2026?
Not from staff.
Excellent. Do we have a motion to approve the agenda for May 13th, 2026 as written?
So moved, Aaron.
Second, Hamby.
We have a motion and a second. All those in favor of approving the agenda, please say aye. Aye.
Aye.
Aye.
Opposed? Abstentions? The agenda is approved. Next item on the agenda is the any announcements?
Yeah, I guess I can speak now.
Perry, hold on just a second.
Okay, sure.
First off, I do have an announcement. I would like to welcome Christopher Hood to the board. Christopher was voted in last month by the VREA board as the alternate member for me. I am the voting member for representative for the VRE board. Perry, welcome Perry, hello, from
Hi.
Paris, from France. Christopher has taken Perry's position. Perry has decided not to seek re-election or selection to the position. His term will end June 30th. So what I'd like to do at this point is have Christopher introduce himself and give us a little background of his teaching career and why he wanted to join the board, and then we'll have the board members introduce each other after Christopher's done. Welcome, Christopher. You're muted.
There we go. I'm new to Microsoft Teams. Thank you, John, for the introduction. Happy to be joining this board. I recently retired July 1, 2025, after a 32-year career teaching math at Champlain Valley Union High School in Heinsberg. I live in Burlington with my wife, 2 kids, recent graduate from UVM and a current sophomore at UVM. Obviously, as someone who's been part of the pension system, contributing for 32 years and so forth, I've always had a vested interest, so to speak, and was active in union activities to encourage fellow members to start 403Bs early, etc. I told John a story earlier where literally the first union meeting I went to, there was a representative from, I forget which program was being offered, I think Value Builder or something. And luckily and smartly got started, I think, with my second paycheck, making contributions to 403B, but then obviously, was fully aware of how important having a fully funded pension fund would be moving into the future, lived through several different iterations of pension reform, and I think it's really important for every teacher to be on top of what's happening with current legislation, et cetera, and how it may impact the pension fund. And I look forward to continuing this work and learning a ton. So I'll be doing a lot of listening. But welcome.
Thanks,
Thank
Christopher.
you. Yeah, thank you very much.
So let's go. I was going to say go around the table, but I guess it's sort of like the Hollywood squares. Let's go around the squares. Dan, would you introduce yourself, please?
I think Dan's not here.
Oh, okay. I was just looking for participants. Okay, Emily?
Hi, Christopher. Emily Simmons. I work at the Agency of Education. I'm the general counsel there, and I'm the Secretary of Education's appointment person to the board and have been for several years.
Thank you. David? Is David, David's not on?
Hi, all. Sorry
You-
about that. It's for the
Oh,
struggles with
there
the mute button. David Scher. I'm deputy treasurer and serving in the treasurer's role as the stand-in for these meetings. Great to see you all.
Thanks, David. Aaron,
Hi, Chris. Aaron Carter.
Uh,
I'm oh, I'm sorry. You said Aaron, right? Yeah.
Yeah.
Yep. Active member, representative, vice chair, math department chair at Spalding High School. I think like 15 years ago, we were at AP Institute at the same time. We might have played bocce together. So obviously you remember that. Nice to see you.
excellent. And who do I forget? George.
George couldn't make it today.
Okay.
Genevieve will be the voting active member in this place.
And so Genevieve.
Hello, Genevieve Hamby. I'm a math teacher at North Country Union High School. I teach statistics, trigonometry, but my real passion is financial math. And if you can look at my board back there, that's all the students that I got to sign up for Roth IRAs this year. So my record is, I think, 35 in a year. And so I'm continuing that mission. I'm also really active in the union. I remember Chris from many union meetings, the RAs. And also way back when, I can go all the way back to Model UN, like I was Burlington High School, and I think you were at one of the area high schools. And so anyway, lots of great stuff that we do with this board. Thanks for joining us.
Excellent, thank you. And Perry.
Yeah, so I'm leaving the board. I mostly just wanted to pop on for a few minutes to make sure I welcomed Christopher and also to thank everyone for being such a supportive and strong group of people over the years. It's been a great pleasure to work with everyone, and I felt I should take a minute and say goodbye. So I'm just here to do that. Christopher, you're
Great.
joining a great group of people.
Perry, and I want to thank you for all of your work, both here at Visters and then also at VPIC. Perry joined the board as a active teacher, alternate member, and then when he retired, became the retired alternate member, and then at that point also moved as our representative representing Visters at VPIC. And has been doing an outstanding job representing us and keeping an eye on our investments to make sure we are being well represented and that our VPIC runs smoothly. And then I also want to thank you for all of your work fixing the language, modifying for Act 114 and helping with the COLA for both retired teachers and active teachers when they retire. So thank you for all your work, your fantastic questions, and you will be missed.
Well, thank you, John, and thanks to everyone. So I guess I'm going to pop off then. It was great to see everyone, and thanks for everything.
Bonjour.
Thank you, Perry.
Thanks,
Bonjour.
Perry.
Okay, the next item on the agenda is approval of the minutes for April 9th, 2026. Do we have a motion?
So moved, Aaron.
Second, Hamby,
We have a motion
since
and a
I'm
second?
live today.
There we go. You get to speak. Any discussion on the minutes? Hearing none, all those in favor of approving the minutes for April 9th, 2026, please say aye. Aye.
Aye.
Opposed? Minutes are approved. I will now open the meeting to public comment. And we will now close the public comment portion of the meeting. And the next item on the agenda is the 403 Plan Quarterly Review. Empower, welcome, folks.
Good morning, everyone. Hi, John, Mr. Chairman, and Chris, welcome. Welcome. My name is Gabe DeLeese, and I'm the relationship manager and lead the team of Empower Associates that supports all aspects of the plan, working very closely with staff, as well as Brian's on the phone with Chip, who's on vacation, who's not here, who also leads we have 3 dedicated representatives. So I would say, as you've come to this plan, the first thing you need to do is make an appointment with Brian. So you make sure you understand everything on how this plan works, Brian and Chip. So please do that at your earliest convenience, and welcome to the board. Excuse me, and to the rest of you. I got a real kick out of that board, though, with the Roth IRAs. That was fantastic, Genevieve. I love that. That was spot on. Okay. I'm just going to share a couple of quick observations. I'm going to provide an overview on a combined view, if you will, of all of the 403B plans, kind of a bird's eye view, if you will. And then I'm going to ask Brian Feisig to provide you with a little field report, pretty much advising or letting you know what's going on, what participants are doing, what are they saying, how are they feeling, and what are they acting, what actions are they taking, I should say. The bottom line here is one of the kind of themes that we're seeing across all of our book of businesses right now is really twofold. I'll call it volatility and affordability. Clearly, I'm sure Sarah and her team are going to talk all about kind of, the markets and all that good stuff, but there is still a lot of volatility out there. Now it's been really good since the end of the quarter. Quarter dropped, and you'll hear about that. It's been obviously on the back rise, but affordability, right? We're starting to see gas prices up. People are still struggling, paycheck to paycheck and trying to make ends meet. So that's what's on people's minds right now, right? With inflation rate now going up, I think, 3.8% as of yesterday. So that's top of mind with participants. That's top of mind. The other thing we're seeing a lot of participants, meeting with their counselors to talk about, am I on the same path? Am I doing the right things? So there's a lot of retirement readiness reviews across the book of business. And Empower just announced its results. 20 million participants. So we got a big client base there, and 2 trillion under assets under administration. So it's something we obviously take very seriously. So it's nice to be able to share kind of what's happening across the organization. It's not just any specific sector. So those were the quick highlights there. What I'm going to do now is I'm going to share, for those of you that may have it, I'm going to share the all 403B. Just can I get a thumbs up that people can see my screen? Are we good?
Yeah. Hey, Gabe.
Yes, sir.
Can I just take a minute to underline something you said earlier?
Please.
Folks, board members might remember that Gabe's his presentations came in 2 parts. There was the exclusive plans, and that's where the Empower 403B is the exclusive plan offered by a particular school, and then a separate report for the non-exclusive plans. I think, John, in particular, you've been asking, can we get these all in one place? And so I really appreciate, and so I really appreciate, Gabe, your work on that, putting it in one place. I think this is going to help us kind of just take the bird's eye view a little bit more. So I wanted to underline that, and thank you for the effort on that.
No, I appreciate that, Tim. Thank you very much. Yeah, that's what we're going to do going forward. And we've attached some additional plans, individual school districts, kind of the top 20 largest at the very end. John, you've always asked, how many participants are in the Vermont teacher programs that also contribute to the deferred compensation plan, which they're also eligible for, as you know. There are 170 participants as of the first quarter that are doing DC and 403B. So as we look at the first quarter, I'm just going to give high level and look at money in, money out, and just wrap it up quickly here. So the 403B program, $230.4 million, representing about 3,800 participants. And of those 3,800, 2,900 are active with a balance. The rest are retirees and individuals that still have accounts active there. When we look at kind of a breakdown of the different strategies, average account balance is about $61,000. The largest equity position is equities, I should say. 61% of the program has investments in equities. And then we look at kind of the investment strategy utilization. And we're going to get into these a little bit. We'll peel back the onion real quickly. My total retirement, about 5% of participants participate. This is a fee-for-service managed account solution, professionally managed account. Free online advice with static numbers and recommendations. Obviously, your target date funds at 16%. Asset allocation, which is Goalmaker. For those of you that may know, Goalmaker is for those new members, Goalmaker is an asset allocation-based solution that participants pick based on their time horizon and risk tolerance that utilizes the funds within the plan. And then there's risk-based, and as you can see there, the majority utilize what's called a do-it-yourself strategy, and that'll also be the most of the assets as well. Lifetime income score replacement ratio at about 70%, which is right up there. But let's look at cash flow, and you could see from a historical perspective, quarter over quarter. So for the first quarter, we saw 4.37 million came into the plan, 4.6 went out in distributions, with a net negative cash flow of about 291,000. As you will see, I want to point to that change in value line. As you can see, for the first quarter of 26, there was a negative 2.3 million. That's market valuation. That's all it is. But as you can see on previous quarters, where there's been a lot of good movement in the market, as you can see, 15 million, 12 million, 5 million, etc. But as of 3/31, that was down that day, and the markets have rebounded, as I'm sure Sarah and team will discuss. But as a point in time snapshot, as of that day, it was down. The valuation of the programs were down $2.3 million, representing $230 million in assets. Participant balances, again, different asset classes. There's a lot of data in here for you to poke through if you want through. I'm just going to hit the highlights here. And again, going to put some numbers near those investment strategies. So you can see there are 221 participants that are utilizing a fee-for-service program representing about 4% of the assets, or $9.2 million with an average account balance of 41,000. 5 that used a free online advice with their average account balance. 600 participants utilizing target date strategies representing about 35 million. Goalmaker, 1,400 participants representing about 55 million, as you can see, and then risk-based strategies, etc. And then the majority of the do-it-yourselfers, the other 1,467 participants representing 55% of the plan assets, or 127 million, do their own asset allocation strategy.
Hey, quick question on that.
Of course.
So the do-it-yourselfers, if I'm a do-it-yourselfer and I choose to be in a target date fund, and then I also choose an index fund, do I show up in both places?
Yes, you do, but that's not an advisable strategy if you were to meet with someone, right? There's different scenarios, and I don't know if Brian wants to speak to it, but if you were, for example, if you were in a target date fund, you put some of your money in a target date fund and some of your money in other funds, yes, you're going to show up as twice, correct?
Okay, thank you.
Yep. It's not advisable, but it
well, do it yourself, or I can do anything I want.
Well, true. But there are a lot of people, John, that will go through the program, get a recommendation, and then from there do it themselves. In other words, they looked at it, they got it certain based on their needs. Now they're going to say, well, I'm going to be a little more conservative or a little more aggressive. So they'll do their own thing. So there's many different ways you could do it yourself. Absolutely. On page 10 here, we just break down the active versus the separated for individuals that are contributing versus those that are not. And as you can see, what we see across not just this plan, but across many, many plans is participants still stay engaged. Somebody coming in. Okay. Participants do stay engaged in the plan even when they're retired and how they're investing their money. Days of taking all your money when you're retired and just throwing them into a fixed income fund are over. Participants again, continue to stay engaged and utilize some of the services that are available to them. When we break down the money, when we look at that $4.4 million that came in for the quarter, 3 million of that was before tax contributions, 323 was Roth, some employer contributions for those agencies that provide it, and then the other represents rollovers into the plan from other retirement plans. And below you get the rolling 12-month period there, as you can see the rolling. It looks like about $1 million, let's call it $1 million to $1.2 million. Some months are better than others, obviously. Where there was a lot of rollovers, for example, in May of 25, representing quite a bit of money. But the breakdown there is the run rate's about $1 million, $1.5 million. That's money coming into the plan. Now we're going to look at the money going out of the plan. And again, of that 4.7 million, 3.2 million were individuals that separated from service. This also includes individuals that are taking an installment payment. In other words, I'm retired and I want $500 a month. That's going to be included in the separation of service as well. So there were 157 transactions. Another 43,000 or 15 individuals that took a required minimum distribution. In-service withdrawals, hardships, credits, sadly, 11 death cases, 367,000. So there's the 4.7 million, and you will see the run rate below. Again, about 1 million to 1.3 million varies at certain times of the season. So generally speaking, money in is equaling money out, with the exception of some valuation at any point in time. But it continues on. It continues on. Loans, boy, I wish all plans were like this. There's only 54 outstanding loans out there. Not all of them have loans, as we all know. But for the folks that do, there's 54 outstanding loans, and there was one for the, 5, 2 in January, 2 in February, and 1 in March, as you can see there. So the good news is loans is available for people that are there, and it's not a popular feature, but that's a good thing, because you want people to know that it's there if they need it, but generally speaking, to save for your retirement. So that's good. Net transfers. I mentioned individual plans just for reference for all of you. We providing the top like 20, if you will. These are the school districts with their assets, number of participants, average balance, how many are separated, loan balances. So we're providing you with some examples here of some data, if you will, for your information in terms of plan insights. And then additional schools here. Again, I'll let you go through them. More statistics on those, participation rate, who's eligible, et cetera. And then that's pretty much it in a nutshell in terms of looking at it from the top down. Happy to answer any questions on that, but generally speaking, it's continuing to move along as to what we expect. I know Brian and team Melissa are on as well. There are some 403B plans, some new schools that are in the process of joining this program, and that's in flight as we work right now. So if there aren't any questions for me, I'd like for Brian Feisick, who primarily works with a lot of your school districts and teachers, provide a field report. But I'll pause there to see if there are any questions with respect to the statistics here at this time. Brian, you're up, sir. Take it away. I'm going to stop sharing unless some people need to share with me. And then when Brian concludes, or Brian, I apologize. Let me do something real quickly here, Brian. Before I kick it to you, I just want to cover one more, the SDIA, which I do real briefly. So let me get out of here. To this one here. Can everyone see my screen here?
Yes.
Okay. I just want to touch real quickly. As of the first quarter, the single deposit investment account, 19.4 million, representing 654 participants. Again, this is a waste-in trust. You hear me say it all the time. And as you can see, it's only distributions only from the plan. And again, for the first quarter, about $455,000. And you can see the quarter over quarter where looks like the fourth quarter, excuse me, of 25 had $1 million go out in terms of distributions. So there's the distributions there. Again, not much activity other than those that do have it that are eligible are using this as a distribution only program. So continues to go down. And I know the board's been talking about what do we do? Do we continue to let it or do something? But that's for you guys to discuss. But I'll just continue to report on it quarter over quarter for your reference. Any questions on the SDIA or the 403B plans before I ask Brian to just share some observations on what he's seeing out there?
Just some interesting context. I just for giggles, I pulled up the same report 10 years ago, Gabe, for the SDIA. Yeah. And that 654 members compares to 1,387 10 years ago. And the assets it was $53 million back 10 years ago. So it is, as Gabe said, just to provide that longer view context. Thank you. It's been winding down, and yeah, I would say in the next couple of years, we're probably going to think about sort of a next step for the plan. Not there yet.
Yeah.
I was just going to do the math myself, with current distribution rates. And that's a good context, Tim. In 10 years, we're over half. So you're right. In the next, I would say 2 to 5 years, we're going to have to start a thoughtful process about what we want to do with it.
I'll make a comment there, which is very good, just to keep in the back of your mind. This was a conversation I had with Chip. I don't have anything to validate at this point, but from what I understand, and Tim, you know, this program was from years ago. So a
Yeah.
lot of these individuals are getting up in age, and some of them are getting really up in age and may not be around in a few years. You know, hope they do, but you got to consider the deaths claims from that cohort of group of people. Just to keep that in the back of your mind. It may go down faster than you think at certain points. Just as an observation point, you know, nothing malice intended there whatsoever. But thank you, Tim. Thank you for that context. I do remember when it was like $45 million, and it's cut in half already, right? In 10 years. Mr. Fisick, I know you're here somewhere.
I'm here. Yep. Good morning.
Attaboy. Make sure you make an appointment with Chris, by the way.
Yeah, I definitely will do. Yep.
Go ahead.
All right, folks. Good morning. Yep. My name is Brian Fisick, one of the 3 retirement plan advisors for Empower. So here to do the field report. Before I get into that, though, John Viave, I just want to echo what Gabe said. That is extremely impressive what you're doing with your students, having that many open up Roth IRAs already. So this is something that myself and my colleagues talk about multiple times on a weekly basis, is try to get started saving for retirement as early as possible. So the fact that you're doing that, very, very impressive. So Q1 typically is always our busiest quarter with the school districts. Everyone's back from their holiday break. Their doors are typically wide open with the different school districts. So our calendars are absolutely full in Q1 visiting all the school districts. Like Gabe said too, the dominant theme really for this quarter was the conflict overseas with Iran. So usually when this happens, when we see something, a geopolitical event happen, not surprisingly, we saw about a 10% correction in the stock market. It happened very quickly. And a lot of times when that happens, it can cause panic. It can cause a lot of worry, and our phones can start to blow up with participants calling saying, hey, what do you recommend? I'm getting a little nervous. Should I start to make investment changes? We had colleagues from some of the other plans that we administer talk about that, saying, yeah, I'm just absolutely swamped. People are calling all day, worried about this, wondering what to do. But Chip and I talked about this a lot. Vermont participants, they tend to be a pretty resilient group. We didn't see the same level of worry and panic here. Yeah, I think that has to do with this plan being a little bit more of a mature plan. So folks here, they've been through these downturns and their corrections, and they know that the best course of action is to just not panic and to stay the course and just work your way through it and wait for things to start reverting and going back up, because historically they always have. So Chip and I talked about it a bunch of times. We were very impressed with just the level of non-panic here in the state and when that correction happened. I will comment too, the newest member of our team, Nick Marinelli, just started end of last year. I think he was introduced briefly last quarter, but he is off to an extremely fast start with us. We have been very, very impressed with him. He is in the process right now of onboarding a brand new school district in the southern part of the state. So yeah, what he's done out of the gate so far has been, we're all extremely happy with him. And the most effective tool that we continue to have when we're in your schools meeting with participants is that retirement readiness review that Gabe mentioned. So this is the tool of ours that we have where when we're sitting down with participants, we can take a look at their whole retirement picture. This retirement readiness review tool allows us to enter in what their future Social Security benefit might be. We can enter in what their state teacher retirement is going to be. Possibly if they have VEMRs instead, we can look at that. We can enter in that info. Any other retirement or investment accounts they have, we can enter in those balances. So really the purpose of this tool is to give folks an idea of how their future retirement picture looks with all of these different sources of income all added up together. And then we also compare that to what their future expenditures might be as well. And I can't tell you folks just how many times we run into this where someone will come in to talk to us when we're in person and they'll have a frown on their face. They'll have a sad look and they'll say, yeah, Brian, I don't know when I'm going to be able to retire. I think I'm going to be working well into my 70s because I just don't think my retirement's looking very good. Maybe I started too late or I'm not saving enough. When we go through this process, though, when we start lumping together their Social Security, their state teacher retirement, their other IRAs or investment accounts they might have, in many, many, many cases, the picture does not look nearly as dire as they thought it was. And when they're able to see everything punched in together, this tool gives them a figure at the end of what their retirement benefit will look like with all these different sources of income added up together per month, how much they might be receiving. A lot of times they look at that and they say, wow, I guess I'm not doing too bad. I'm in a better position than I thought I was. So we try to do this retirement readiness review with every single active participant that we can. Anyone who's enrolled in the plan, we recommend going through this process. It usually only takes about 10 to 15 minutes. We do these in person and then also virtually over the phone. When we're chatting with participants, we can do them. It's a recorded call that we do. So it's a very effective tool for people to be able to see their future retirement numbers. One of the advantages of this tool as well as once we enter all this information on our end, it does transfer over to their online Empower account. So when they log in next time to their Empower account through the Empower website, they can see all of these numbers on their end and they can make future changes and edits to them. So if their Social Security figure, for example, needs to be updated or their state teacher retirement number needs to be updated, they can make those changes on their end to see then how it affects their retirement figure. And they can also add in, spouse, partner retirement numbers. So again, it tends to be the most effective tool that we have. So Gabe, that is it for the field report. I will turn it back over to you.
Thank you so much, Brian. Are there any questions for Brian that anyone has? I will say, folks, one of the benefits here is that we have 3 dedicated representatives, serving there are plans that don't have dedicated reps. So a lot of your participants, your retirees, they know these people. Some go back quite a ways. So they have these personal relationships and it really, really does help. So Brian, thank you and the team for what you do. Any questions for Brian? Well, then on behalf of all of us at Empower, thank you for the opportunity to serve you. And of course, we're here for questions and we appreciate your business. So with that, Mr. Chair, I'll turn it right back to you, sir.
Thank you very much, Gabe.
Thank you.
Sarah, welcome.
Good morning. All right. Well, good morning, everyone. Welcome, Chris, and myself, Ramnik, who's also with me on the call, and the rest of our RVE team are here to support, to let us know if there are any questions as you go through materials and review the plan and investment performance. Our agenda for you today, and I'm going to share my screen. Hopefully you can see that. So our agenda for you today is to cover the quarterly performance update and just the quarterly watch list update. So very investment focused today. Just very briefly on capital markets before we jump in. The first quarter, as you may recall, was a bit challenging for investors. There were 2 big themes really moving markets. The first one was a military conflict in the Middle East. The US-Israeli strikes on Iran that started end of February really disrupted a lot of markets and caused, energy prices to sharply move higher, and markets' initial response was really negative to that. And then the second item was the repricing that we saw within technology stocks. A lot of investors were really growing extremely concerned around how AI could potentially disrupt valuations within the US technology space. And this really led to a lot of market underperformance, which is why on this page here, what you saw in terms of market performance was that large cap fell about 4.3% for the quarter, while on the other hand, international stocks held up way better. Small cap stocks actually posted a modest gain in Q1. Bonds were relatively flat. So it's a quarter where diversification, having a mix of different investments within your account really helped. This is actually a continuation of a theme that we saw last year as well, where we saw, at least in the first half of the year, similar themes around international equities and small cap doing pretty well. So why did small cap hold up so well? small cap tends to respond more to economic results at home. A lot of the revenue comes from domestic consumers within the US. So on the economic fronts, we saw things remaining reasonably healthy this year, despite all the international tension. GDP growth came in at 2% in Q1, which was a solid bounce from Q4, where it was a bit flat. Inflation is running a bit above the Fed's comfort zone, but still within bounds. Unemployment is still within range as well. So, so overall, the Fed is holding rates steady, striking a cautious tone and trying to be data-driven, looking at inflationary pressure, potentially from rising oil prices. But beyond that, there are really nothing in the economic data that suggests concern within the economy, and this has really helped small cap in the US. April saw some relief on the geopolitical front, as you probably know, with the ceasefire, and markets really rebounded quickly. But today's report really covers through March 31, and what you'll see is equity markets really being challenged, particularly within the US, driven by all those tensions. One quick note on the DC front, we wanted to share in late March, the Department of Labor actually issued a proposed rule clarifying how planned fiduciaries, meaning this board, should think about selecting investment options. Comments are due June 1st, and the final rule is expected later this year or even in 2027, which means really there is still nothing that is final. But it does, this rule does, it really opens the door more explicitly to things like alternative investments inside plan menus. And we think it's also introducing a significant piece of regulation. It has a lot of details within it about how fiduciaries should go about vetting and selecting options. So no action needed today, just wanted to put this on your radar as something we may bring up again in the near future, and try to dive deeper into what the rule really entails once it becomes final, if and when it becomes final.
Sarah, if I could just jump in on that as well, I think this rule to me sort of signals that it seems, and maybe you can correct me if I'm wrong, where there's a change in administration, there's often an appetite to revisit the fiduciary rule, take another look at it, and put that administration's own stamp on it. I think one of the important things with the fact that you do have some flip-flopping priorities from administrations is really to focus on fundamentals, as I think this board's been doing over the past few years, working with RVK to make sure that whether or not there may be a preference for alternatives from one administration, maybe something will change in the future. I think the sort of procedural due diligence work that we've been focused on long term is going to be something that at least I want to focus on when we're thinking about how we approach our plan selection and monitoring and whatnot. And that's been a big focus of the work we've been doing with RVK, and that we're going to continue to do over the next few years. So just wanted to provide that context on this rule. Obviously, it's always important to keep an eye on what's in a specific iteration of a rule like this, but bigger picture, I think fundamentals are always key.
Yeah.
I'm hearing crypto's not in our future.
I don't think so either. I echo everything Tim said. This really, while alternatives may not be as relevant to our plan here, I think what will be potentially relevant is the heightened focus on having a detailed documented process for manager selection, because it, as we both said, it really goes into a lot of length describing different areas, different factors that would need to be evaluated in selecting managers, things that we wouldn't even typically think about, like, and for good reason, valuations, liquidity, but it kind of also makes us think maybe we should be documenting those things in more length and in more detail, even though they are not as relevant outside of alternatives. But it's I think we're having also an internal conversation, and there's a conversation within the industry on how that kind of impact our processes in general, and how to kind of make sure that we're aligned with any potential rule that may be rolled out. So with that, from a high level, I think Gabriel did an excellent job covering just high level plan metrics. On the SDIA side, like he said, kind of it's really depleting plan. It's all of it is invested in the State of Vermont Stable Value Fund managed by Mission Square. I'm gonna come back to this fund later in the watch list section. So I think we can move on here. From here, nothing in terms of cash flows or trends that is different from what we've seen in the past. On the 403B side, assets were held at around 230 million. We saw a modest dip in assets and a small decline in participants. Nothing significant. Participation level has been somewhat stable, but it has trended a little bit down just between those 2 quarters. This flows have generally been neutral. So inflows and outflows have generally offset each other during the past 4 quarters, more or less. Just something worth noting, given that this is a plan that is really has an generally active working age membership, and more mature, but it's generally more active participation for the most part. So we definitely would like to see net positive inflows, but so something to keep an eye on, but nothing concerning here. Overall, the fund that holds the majority of assets here is the Vanguard Institutional Index Fund. Nothing, I guess, that is out of the ordinary. It's typically a very popular option. It's an S&P 500 fund. It actually, interestingly enough, and I think echoing what Empower said, despite the market performance during the quarter, and this actually saw an increase in participation over the quarter. So that's interesting to see. Not by much, but it certainly was notable for us. In terms
I got a quick question about the index funds. I read an article in the New York Times a while ago that index funds, and it was sort of a broad stroke conversation about them, saying that they're not as diverse as they used to be, and they seem to be more core. They're not, the number of stocks or the number of investments are not as diverse. Are you seeing that also in index funds?
That is spot on, John, actually, yeah, Jonathan. So we, especially, and that is more applicable to the S&P 500 option. That's the option that is the most popular, where the top 5 stocks have really dominated market cap. The majority of market cap is in those top 5 stocks, and unfortunately, with their outperformance of those mega cap names over the last couple of years, their share of the index has only been increasing. This has been actually reversing a little bit, but that is one concern with index funds, and that is one argument for why maybe someone might want to be in active options. But it could also be an argument for holding a small cap index fund or a mid cap index fund, which you have some of those, and those tend to be more diversified. They also are market cap weighted, but you don't see the same phenomenon you have with the S&P 500. So I would say it's a bit more nuanced, but I think the trend, I think I echo what the article is saying in terms of the trend, especially for the S&P 500.
So in your opinion, the Vanguard funds that we have now are still diversified enough, but just
correct. I would say it's you should never hold just one single option like the S&P for the institutional index fund. If participants are holding multiple, are investing across the index fund options that you have, they should be much more diversified. So investing passively, I think, would not be a bad idea if you know how to kind of hold diversify across options, but it is certainly becoming a bigger concern. So that's why it's a good thing that you're also giving folks access to active options, and the T. Rowe Price target date funds are fully actively managed. So you don't see the same concentration that you're seeing on the passive index option side.
Excellent, thank you.
Sarah, can I make one comment that I did not mention in my report? And I just saw it here. Just as a reminder, folks, you'll see the Lord Abbott Fund that's in this plan. That was recently replaced on April 6th. It'll be reflected in the next quarters. This was a fund change that the board approved. And one of the main reasons, not only performance or that they looked at, is the expense ratio came down substantially. So it's much cheaper. And that's clearly a benefit of those Vanguard funds. And remember, you got Goldmaker, you got the target date fund. So there's good diversification, I would contend. But there was a fund change that I wrote down that I did not mention. So I just wanted to mention it now. Again, no action needed. It went through. It's all well done. But there was a change on April 6th. Thank you, Sarah, for the opportunity.
Thank you, Gabe. So in addition to what Gabe said, maybe a couple of comments overall on the menu usage. High level, overall, I think we're seeing the same breakdown we've seen in prior quarters in terms of menu usage. About 60% of participants are in what we would call a do-it-for-me options, whether it's target date funds, managed accounts, or Goalmaker. That 60% is in line with peers in mature plans like yours. So a little bit of uptick in managed account and Goalmaker usage over the quarter, in line with prior quarters since we've been with you all. So there's definitely a slight shift toward more guided approaches is, I think, the key theme we're seeing here. Shifting to the monitoring dashboard for your managers. Overall, given the market environment I just described, Q1 results across the plan were largely what you would expect. Areas with funds with more US large cap exposure faced headwinds. International and small cap held up better or even gained. Fixed income was a bit more flat. The two plans have 10 core options, identical menus with the exception of the guaranteed long-term fund on the exclusive side, and then the non-exclusive used to hold the Lord Abbott short duration, which, as Gabe mentioned, has already been replaced in the beginning of April with Vanguard Money Market Fund. And overall, on this page, I think we summarize some of key metrics that we think are helpful to monitor, but of course we encourage you all to go through the rest of the report for just a much richer view of the plan overall. Qualitatively, really high level, there hasn't been any meaningful changes to teams or strategies. We will talk a bit more about managers that you have on the watch list in the later agenda items. So that would be Calvert, Impacts, and the Stable Value Fund. So I'm gonna skip them for now. For all the other managers, qualitatively, everything is in line with the past. We looked at manager team and organizational changes during the quarter. Fees remain competitive across the board, and manager research ratings remain the same as last quarter. On the performance side, maybe just a couple high-level comments about your managers. T. Rowe Price, that's your default option. You have 6 vintages. This is positively rated, really in good shape. The team, as we mentioned in the past, has taken a more conservative posture relative to its strategic benchmark over the last few years, which has been a headwind to its performance. That's why you see some red there. But this is them comparing themselves to a long-term strategic target. But if you look at their peer group ranking, they have done really well compared to peers across most vintages and time periods. Performance was challenged a little bit in 22 and 25. due to some tactical allocation decisions there. But otherwise, it's been really a great manager, and we really have favorable view of them in general. Your passive options, we talked a bit about it already. All of them, as you see, it's fairly green. They're all tracking their benchmarks within normal range. Already talked about just trends there. Small cap was actually up almost 2% during the quarter. International was up close to that, 1.8%. Good reminder of value of diversification there. Within your active fund, I'm going to skip Lord Abbott here, giving the change. But PIMCO total return has actually done well over the last couple of years. Faced some headwinds this quarter, but we're happy to see their performance rebounds over the last couple of years compared to prior years where they had some headwinds, and you can see that in their longer term performance being more challenged, but overall no concerns with them. You have the guaranteed long-term fund also has done well, returned almost 1% this quarter, strong results overall long-term. The balanced zero price fund also has done well, and it's conservatively allocated relative to the benchmark. It's not really a great benchmark for them, which is, but they have generally done well. Cash flows, I'm not going to spend time on that since this has been covered. The only thing we've seen that's really interesting there was in terms of exchanges, we've seen some movement from equities into stable value and the total bond market index, not unexpected in a volatile market, but it's also not significant either. And we also saw some outflows from the target date funds and into the core menu, which is in line with what I described earlier about an uptick in goal maker and managed account usage. So this covers all my performance comments. I want to pause to see if there are any questions before we just spend more time looking at the watch list. All right. So turning to the watch list, as I mentioned, you all have 3 managers currently on watch. I'll spend a bit more time on the third one, the stable value fund. But from a high level, Calvert Equity Index Equity Fund, this is a large growth manager. It has a quality focus in addition to its ESG or sustainability orientation. Both of these have actually been a headwind to performance in recent years, which you can see on the page here. Quality underperformed. Performance, like we said, has been dominated by a small number of names. So this has really hurt their performance. Over the quarter, the performance has pretty much matched the benchmark. We are a bit disappointed by that because after 3 years of underperformance, we are hoping to start to see them rebound and kind of outperform peers and the benchmark in order just to start catching up with the benchmark. So going forward, I think what we're hoping to see is that they start to perform better. There has been no team or process changes since we've added them to the watch list, and we actually have a positive view of their manager and their team. So we'll continue to monitor them and report back on whether performance starts to recover as market leadership starts to broaden, which is something we are starting to see where smaller cap, like I said earlier, is starting to do better. So this should help managers like Calvert. The next one on watch is Impacts. This one invests globally in companies that are tied to environmental themes. So energy efficiency, renewables, water, natural resources. It's been on watch for performance challenges, but they've also announced some team changes earlier this quarter that we consider to be important in their own right. On the performance side, as you may recall, they've had a few rough years, consistent with other ESG managers, and which made sense also given their investment style, which also had the same headwind, had limited exposure to mega cap technology names. So the performance made sense given their style. The team changes that started end of last year, however, and continued into Q1, give us additional pause on the strategy. So historically, this strategy has been managed by 3 co-lead portfolio managers, which is something we really like to see. Late last year, one of those 3 left the firm and was replaced. Normal to see, no concerns. And then in the first quarter of this year, the other 2 lead portfolio managers, however, also departed and have been replaced by other folks from within and from within the firm. So what we now have is a brand new portfolio management team that is relatively untested. And manager research is doing additional due diligence on the new team, and we want to give them time to demonstrate that the investment process remains disciplined and that it will support strong future outcomes. But this is definitely, I think, an additional area to monitor for the strategy. Overall, continue to recommend keeping them on watch while we monitor their execution and make sure performance improvements will be sustained after having a strong quarter-to-date performance. So they did really well in Q1, outperforming by more than 2%. All right, which brings us to the one I really wanted to spend a little bit more time on, because we have a bit more to update you on for this one. So as you know, the Vermont Vermont Stable Value Fund managed by Mission Square sits within the single deposit investment account, but it's also in some other in Vermont supplemental plans. Performance of the strategy has actually been decent. It ranked within the top quartile and performed in line with the benchmark for over the long term. So no performance concern. And I wanted to make that clear and acknowledge that first. Our concern with the strategy has been with the organization and the investment team managing it, and what this could mean for future performance for the strategy. Over the past 2 years, Mission Square, as you may recall, experienced significant and ongoing leadership turnover. There has been multiple consecutive changes to the team managing the strategy as well as the investment organization at Mission Square in general. So multiple CIO changes, same with the fixed income team leadership. The lead PM of the strategy also has changed, and other senior figures as well. So this raises a red flag for us. We've met with them several times over the course of the last 12 months, including more recently, actually, about 2 weeks ago. It was a productive conversation, and I think they're taking reasonable steps to maintain stability within the strategy. But it didn't fully resolve all our concerns about the team structure and the investment decision-making on the strategy. So we also used that meeting as an opportunity to probe them a bit about the mechanics of what an exit from the fund could look like. So we just wanted to make sure that the fund liquidation process is consistent with other stable value managers and with our expectations. So the answers were very reassuring on the operational side. So they follow standard process. Similar to other stable value managers, Mission Square requires a notice of redemption about 12 months ahead of the liquidation date. This is standard in the industry. These are guaranteed insurance products. So to make sure you are getting your value at book value, you want to give them that advance notice. Nothing concerning there. We also confirmed with them that directly what the mechanics of how this works is also consistent with the industry, like participant transactions. After giving them notice, will continue at book value. Everything continues as usual, and that the eventual settlement process is also consistent with expectations. So no red flag so far. We are a couple of outstanding questions to them, just asking for more data on planned fund flows and plans, etc., that we're still getting. But overall, we were happy with their responses. And after that discussion, Steph and RVK discussed all of this, and we want to bring you just as an update on that front. So given the continued organizational uncertainty and the significant turnover we've seen, we think the best course of action today is to issue a formal 12 months notice of our intention to potentially redeem the investment in the fund. And I want to be very clear about what this means. So a redemption notice in this case is not binding, meaning it can be rescinded. It can be rescinded at any time before the 12 months are up. And if we don't confirm the redemption after the 12 months period concludes, nothing essentially happens. So there's no obligation to follow through with a redemption after you give notice. This is simply us keeping our options open. We want to, as we complete our due diligence process. So think of it as an operational step that staff and RVK are planning to take. So to confirm, staff and RVK, we are not recommending the termination of Mission Square at this time. We actually don't know if we're going to recommend that after the end of our due diligence. And there is no action item for you today. But because stable value funds by design require a 12 months advance notice before a plan can exit, right now we're thinking that if our ongoing review raises any serious concerns, say 6 months from now, we want to have the ability to act on those concerns without having to wait another full year. So by issuing this notice today, we are really starting the clock, basically, on the due diligence process, preserving our ability to act if the evidence and if team changes, organizational changes suggest that action may be warranted. So this really gives us options. So our plan, and I'll see if Tim has anything to add there, and before taking any questions, but the plan here is that we will be continuing our due diligence process, reporting back to you all with updates over the next quarters, potentially bringing a formal recommendation either to remove them from watch or potentially to redeem and replace them with another manager. And we will have sufficient time to do that. If we decide to do a manager search, we think that the 12 months period will be sufficient for us to potentially make a decision to do a search, go through the search process, and kind of discuss next steps with you all. Tim, anything?
Yeah, thank you, Sarah. I think that this is a prudent step. This is a unique beast in our portfolio, in that this is the only type of fund that requires this kind of long period of time, this 12-month advance notice, and there's sufficient cause given the turnover at the senior management level and the what's happening with the organization itself to say, well, there's a potential to do it, so let's get in line. Insofar as there's no downside and it preserves the board's full optionality going forward, we think it's a prudent step. I agree with Sarah and appreciate their continuing diligence on this fund. But it's not something at this point that needs board action. This is really just to preserve the board's hand should it choose to act over the next 12 months. And so this is really being provided as a heads up. We didn't want we didn't want to come to you after we've done this and say, say we've already taken all these actions, just trying to signal where we're headed.
Yeah, exactly. Yeah, no action is required. So yeah, we just want to be transparent with you all about this process and why it's happening, and welcome any feedback also or questions on that from you all.
So after the 12-month period, so we're at 11 months, 15 days, and we're pleased with the changes that are being made. They're now more stable and moving forward. So we say we're removing the redemption notice, and then a month later, the fur hits the fan, and we're worried again. Is it another 12-month notice? Does the clock then resets for another 12 for redemption?
Correct. So
Okay,
if we unfortunately, if we decide to kind of relinquish our place in the queue, if you will, then the clock starts all over again.
okay. So there's nothing to, I mean, I guess my feeling is we've got 12 months to take a look at this and kick the tires and make sure everything's going well, and we'll take it down to 11 months, 29 days, and then make the decision.
Yeah, exactly.
Perfect.
Hopefully we'll know a little bit before that.
Oh, I know, but again,
Yeah,
this is like an extended, this is like an extended warranty a bit.
That's right.
Great. All right. So no, I appreciate the feedback. Any other comments on that or anything else that I just shared with you all today? I know I went through a lot in a short amount of time. All right. Well, thank you for your time. I think overall, no concerns, everything, steady as she goes. And we'll keep you, updated on any other changes or updates with your managers in the coming months and quarters. So thank you all for your time, and good seeing everyone today.
Sarah, thank
Thanks,
you so much. That was excellent.
Thank you.
All right. I think, Dave, thank you. Thank you for your report, and we will see you next quarter.
Thank you, Mr. Chair. Have a wonderful week, everyone. Thank you all.
Thanks, Gabe.
Bye.
All righty. Next item on the agenda, the VSTRS health insurance contracting.
All right, Mr. Chair, I think this is one where we would like to, because we're going to talk about contracting strategy, we'd like to have this discussion in executive session. So if I could ask Justin to help us walk through the necessary motions.
Sure, and this will be two motions, one of our favorites. So motion one, move that the board find that premature general public knowledge of information concerning contract negotiations would clearly place the board at a substantial disadvantage.
If someone comfortable making that motion.
So moved, Hamby.
Second?
Second, Aaron.
All those in favor of the motion, please say aye. Aye.
Aye.
Opposed? Second motion, Justin.
Based upon that finding, move that the board go into executive session to discuss the contractual matter pursuant to 1 VSA section 313A1.
Someone
So
willing to make
moved,
that?
So moved, Hamby.
Second?
Second, Aaron.
We have a motion and a second. All those in favor of the motion, please say aye. Aye.
Aye.
Opposed? We are moving into executive session.
The time is now 10:10. One moment as I secure the room.
And Bill, could we invite the phone number to exit the meeting at this point?
Absolutely. The phone number ending in 7742. I'm taking note of your phone number so that way I can call you back or send you a text message once we are returning to the meeting. So one moment.